Hello, good morning, good evening, everybody. Thank you for making time to join StoneX's first post FOMC call of 2024. This is Robert Hong and his colleagues from Fixed Income Sales and Trading in Asia hosting this event with, in the US, Kathryn Rooney, Vera, who's StoneX's Chief Market Strategist, and Stephen Gola, who runs the U.S. Treasury sales and trading business. So on that note, we will venture into the post-February FOMC events and notes. So if Kathryn can take it away.
Thank you. Thank you and very much for joining us, and good morning to everyone. I'll give a brief 5-minute overview of what we foresee happening in 2024. At StoneX Strategy, we just published our 2024 annual, which is an outlook that spans across asset classes with economic forecasts. So our economic forecast for the U.S. economy this year is for growth, real growth, of 1%, and that compares to last year's growth, which we expect after revisions to come at between 2.6 and 3%. So remarkable real economic growth in 2023, and we've seen a carryover into 2024. So likely first quarter growth is going to be strong. I have finishing this year core PCE at 2.6%, so not too far from where we are now, with the most recent core PCE number coming at below 3% year on year, which is fantastic news for the Fed, who has seen a very swift move lower towards that 2% core PCE target. So let's get into rates. The most likely scenario is the Fed does not cut in March. This is a view that my team, and I think Steve as well, has held for some time, and that is because of the remarkable nature of economic growth and the labor market. The Fed is unlikely to cut in March, but we do think they do start to cut in the back end of 2024 in June, likely to cut some 100 basis points in totality. So what this graph is showing here is that the budget deficit remains exceedingly large, and the balance sheet, the balance sheet is the Fed. Excuse me, 1 second, please. I'm so sorry. That's what happens when it's 8 p.m. and you have 5 children. Excuse me. So what I was referring to is the budget deficit is very large and the price insensitive buyers are buying less. I'm specifically referring to the Federal Reserve, which is winding down its balance sheet, as well as China. China is diversifying its Treasury holdings into gold and other assets. And we've seen U.S. Treasury holdings of China descend as a result. This is an unfortunate timing, however, as we've seen interest payments or interest expenditure versus GDP virtually double in the past year, causing, in my view, the term premia over the long term to move higher. So what are the repercussions here? This is something that I was discussing earlier with Steve. Fed and foreigners now own less than 50% of outstanding U.S. Treasury issuance. Those are the price insensitive buyers. Those are the guys with the current account surpluses, the fiscal surpluses. That's the Saudi Arabias, the Russias, the China, and the Feds of the world, price insensitive buyers. And they now are decreasing in their weight of Treasury holdings, which is another kind of long-term negative for the Treasury market with the bond vigilantes or the private markets, the more price-sensitive buyers picking up that slack. So what we're talking about, the bond vigilantes, they need to consider reinvestment risk, as 5% won't last forever. I talk about this in the next slide as well. This is clearly the Treasury yield curve. You have reinvestment risk at the front end, and then you have duration risk at the back end. And what makes sense for us, and I finish talking about this as a specific trade idea, is as the markets start to price in, which they de facto have, but as those rates start to come down, that means that the short-term, very liquid stuff like money markets, which have grown in assets under management to record $6 trillion and to the upside, likely that cash is going to come off of the sidelines as yields drop. So money markets, 5.3%. They can move into treasury notes in the 2-year space, in my view, and that's going to be a positive for short duration treasuries as that money comes off of the sidelines. And I think I have a chart. Yes, here it is. The very next slide. High yield money market, 5.3% yields. Assets are at record highs with more than 6 trillion assets under management. Investors could move their money from money markets to 2-year treasuries as the yields come down, given that likely flow from money markets. So that's something that we like, and this is something that Steve Gola, who, as Robert mentioned, the head of trading of rates, had mentioned to me earlier, and I just grabbed a screenshot of this in Bloomberg, which is the spread when you consider 2-year yields versus 1-year Fed funds futures, as he very correctly pointed out, that it's very cheap. So I think that both technicals and a structural view on flows could be beneficial for the 2 years. The 10-year, my forecast for year-end 2024 is 375. Our fair value models show that the likely fair value is about 3.5%. And with Steve, and when we were talking earlier today, we thought there's a very good chance that we could see 10-year treasury yields move lower before they come back to that 375 year-end target. But I'm going to hold that target for now. The 10-year yield is currently trading very close to what I think is fairly valued. If you look at things from a standard deviation perspective, with breaking 3 standard deviations back when 10-year treasuries broke 5%. So in my view, anything at above 425, 450, if we get there, is a buy for the 10-year treasury. This, I'm happy to answer any questions about it, but this is a Gunlock double line model that we replicated at StoneX, which helps us determine fair value when we consider multiple indicators, but principally US nominal growth rate versus the German average 10-year yield. And that to us says that rates are probably still a little bit too high. So where do I finish with this? And I'll finish here. 5s, 30s is my preferred trade. I believe it's in line with our trading desk as well. 1 month ago in December, I said 730s. And that was in line with, that was in consultation with our trading desk. From the research perspective, we like to use Steve and his team because they see the flows, they know the liquidity, and they help us come to these decisions. So 5s, 30s is what we like now. 5s look attractive. It's the belly of the curve. The 5s generally outperform under a variety of scenarios. I put 60% probability on a soft landing. I put 40% probability of a recession. Recession at 40% is a pretty high probability when you consider that 20% is consensus expectations for recession this year. The typical level of 5s, 30s on the date of the first cut is about 66 basis points. That's versus 26 today, and a 6-month forward 5s, 30s is at 35. So we're expecting this trade to have additional upside. And this is a summary of my points. I think real rates are significantly above estimates of neutral. I think the Fed has room to cut. I think they cut starting in June. I think they cut 100 basis points. If we enter into recession, I think they cut 300 basis points. If there's a reacceleration in inflation to the degree that the Fed is uncomfortable with, then we get fewer than 100 basis points. And I'll close with this, but my base case scenario is for the S&P to finish at 5,000, the 10-year treasury yield to finish at 375. Inflation to finish at 2.6%, and economic growth to slow from 3 last year to 1%. So we avoid recession and we attain that nifty a soft landing. And with that, I'll pass it to you, Steve.
Thanks, Kathryn. Always great to hear your thoughts. And it actually makes it quite easy when we're on the same page in a lot of things here in fixed income. So I'll try to make things, a little bit different by maybe focusing at first on, just my interpretation of the FOMC meeting yesterday. I'll just start here by sharing my screen. And sure, I mean, I just think I'll tell you what I think the Fed was thinking. I'll tell you what I think the market was thinking. Obviously, an interesting meeting, and I would say probably a little bit of a surprise for me based on the backdrop and what I was expecting going in. Still, we'll try to interpret their thoughts. From the Fed's perspective, I would say they are a combination of uncertain, most likely, I think they're definitely trying to thread a needle, not just in this past meeting, but in prior meetings as well. And for sure, as financial conditions have moved around, I think they're trying to manage the process of this pivot. A market's perspective, what is the market thinking? I think there's a lot of conditioning involved in the markets, always trying to err, or really it's a monotonous ear, because they can only hear either things are entirely dovish, or well, they either need to be entirely hawkish, or anything else is just simply dovish to some degree. With that, I'll just kind of look at the backdrop going into this meeting, and again, why this was a bit of a surprise. The pivot, people have been talking about this, the Powell pivot, the Fed pivot. It happened a few meetings ago. I would say for different reasons. Then I thought they would be a little bit dovish in this meeting as well. If you go back to November, obviously the key comment in Powell's language was referencing financial conditions. You had 10-year notes at near 5%. Spreads were much wider, and so there was a clear dovish pivot at that time. Another dovish meeting in December, finally admitting that the Fed had discussed rate cuts, and I think those two meetings together kind of set us up for what I thought would, I'm going to say almost certainly, but I thought there would be a recognition of a much softer inflation backdrop than even two months prior. In a matter of 2 months, core PCE went from 3.4% down to 2.9% going to this meeting. And importantly, that number was 0.3 of a percentage point below what the Fed was forecasting for the end of last year. So combining the prior meetings with where inflation was, I was expecting a more dovish stance from the Fed yesterday. Certainly, they were met head on with, stronger GDP surprise at 3.3%. Met head on with, a labor market that doesn't seem to want to crack. And so then what? So then what do they do? As I said, I am sure some degree of uncertainty. I'm sure there's some surprise on the Fed's part that, inflation can come down as quickly when the economy is strong, or frankly, that the economy is, or the labor market is as strong as it is, given, some of the PMI readings sub 50 points. In terms of, trying to thread the needle, they've been in different situations in the last few months. And they've had to err on the dovish side in November and December for different reasons. And in November it was for financial conditions. In December it was out of fear that they would stay too high for too long. And then, in this meeting, I think for certain they were thinking about it from a different angle, at least in retrospect, thinking about it from a different angle, in that, they're not concerned about being, things being too restrictive, but not restrictive enough. If you look at financial conditions over the last few months, financial conditions, the Bloomberg Financial Conditions Index is the easiest it's been since January of 22, which is before hiking even began. And even before hiking began, the S&P is up 11-12% since the start of the hiking cycle. Certainly not what you would expect after you've raised several hundred basis points. And Kathryn pointed this chart out as well. But the year note versus the 1 year forward Fed funds, not only points to what you might say is a cheap 2-year note in value, but from a Fed's perspective, it might also point to a market that may be a little bit ahead of itself in terms of what it's anticipating for eases. And so there's the Fed managing the process. In terms of the markets and what are the markets thinking? I mean, I just put a chart here on the different benchmarks yesterday from just before 2 p.m., just before the meeting press release was released. Those are just kind of yield changes versus 2 p.m. You don't see really a lot of curve movement, especially by the end of the day. Markets obviously reacting to different comments about not likely to reach the level of confidence by the March meeting to ease, versus comments about policy rate being already having achieved its peak and being well into restrictive territory. But I think the real takeaway is probably the right side of that chart, which is just, benchmarks across the curve in what looks like, virtually parallel fashion, still decided to rally by 4 to 5 basis points from the start of the meeting, and really rallied, between 13 and 9 basis points across the curve since the start of the day. And so even with an attempt at a little bit more of a restrictive slant, markets have come away with one conclusion, and that is, again, it's monotonous hearing. And if they hear something that, the hiking cycle is over, that's confirmation for them. And if the hiking cycle is over, there's really only one direction going forward. And so a lot of the emboldened buyers over recent weeks, despite what the Fed said, again, they still see cuts in the future, still feel confident about purchases from here. And that seems to be the path of least resistance in the market's mind. And I don't necessarily blame them, given the path of PCE over the last few months. I'll stop there. Just kind of thoughts on yesterday. I'll stop there, and certainly if anyone has questions about flows, duration, markets, curve, happy to answer those, as well as any other questions.
Sure. Thanks for that, Steve and Kathryn. We actually do have a few questions trickling in, and I opened up to the audience also to ask subsequent questions and whatnot, depending on how Steve and Kathryn answered your question. First one is, there's a question on Bank of Japan's monetary policy changes. What do we think in terms of what the impact might be on the U.S. Treasury market?
I'll jump in with some, I guess, probably simple thoughts. I know in recent, I guess, months or quarters, when the BOJ has hinted at a widening band at which trade, the snap reaction has always been, weaker bond market complexes around the world, perhaps led by Japan. That being said, I also think, thinking about it maybe more logically, the longer term consequences historically have been a richer yen, a cheaper dollar, and along with cheaper dollars, as Japanese investors in particular at that point are going to look at the cheapness on an FX perspective, and oftentimes that outweighs. Well, obviously it makes if yields are the snap reaction is the yields go up, automatically you have a higher yield. And if you combine that with a cheaper U.S. dollar, it certainly gets a lot easier to become interested in U.S. rates. So, typically, a short-term cheapening of the market, but very much a buying opportunity from the Japanese perspective.
Okay, great, thanks. Yeah, so the next question we have is something thematic this week. The event on New York Community Bank Corp. There's a question that, do you guys think this is a repeat of Silicon Valley Bank we saw around this time last year, or will things be sped up by the authorities, or would this derail Fed's action plan this year? Kathryn, do you want to throw a stab at it, or?
I'll throw in my 2 cents.
I think that's one for Steve.
Got it.
I'll throw in my 2 cents, and this is maybe intuition more than anything, but one, the concept in an earnings release that they would need to raise capital. I don't think it should necessarily surprise too many people, right? If you're gonna load up your balance sheet with a lot more assets, of course you need capital to support them. I will say, from the regulator's perspective, I would have to think it's really hard to think that a regulator is going to allow New York Community Bank or any other bank to assume a lot of assets from these distressed banks dating back a year, and then let them fail on the same distressed assets. So right away I'll say if I'm thinking about buying any bank stocks, it's probably the best discount you're going to find. However, I will also say it's a bit concerning. It would be hard to believe that there's only one bank out there that has issues. And in terms of derailing, and I'm not sure which way you meant when you said the Fed derailing their plans for the year. But I heard Kathryn say if we had a recession, she could see a 300 basis point ease. I will say, if you meant derail from the standpoint of not ease as much as the market is expecting, not ease as much as the market is expecting, I think it definitely raises the likelihood that it actually comes to fruition. Again, I don't think there's one bank out there that has issues, and so how do you play this? The Fed is going to ease. Do you buy duration? Do you buy the front of the curve? Do you put on steepeners? It's hard to say. My response would be duration for sure, but where? And you don't know exactly how the Fed's going to respond. And I think you wind up having to buy across the curve to the extent that they respond aggressively. You want to own the front end, of course. Now, I'd argue too that to the extent they respond aggressively, we saw what happened with financial conditions after SVB. That must make it more difficult to achieve their inflation objectives, and so maybe the back end doesn't perform that well. Maybe they don't respond very aggressively, so you want to own some back end. So I guess my answer would be owning a blend of maturities across the curve with any fears on that.
Okay, great. Thanks, Steve, for the detailed answer. The next question we have is the general markets. There's been some commentary recently on the outflow from money market funds into longer dated treasuries, 2 years and beyond, and or into other asset classes. What do you guys think, and what's your view on how the overall risk-on type asset classes will benefit from lower rates that we're anticipating this year?
I'll jump in on that one if it's okay, Steve. I think
Sure.
that in a risk-on environment, the carry is still there. So all of the high-yielding assets are going to catch a bid, even more so than they already have. So if, as we expect the Fed to cut, that makes cash less attractive, money markets, CDs, and that money will likely rotate into other asset classes, not exclusively the 2-year Treasury. It just makes sense to me. It's a complementary asset class, and the Treasury benefits from that decrease in rates. On top of that, as Steve had pointed out, they're historically cheap. But apart from Treasuries, I would say that you can expect small and mid caps to do well in the equity space. I think guys are going to be chasing the cyclical laggards. That's consensus right now, and I suspect that's correct. So the equally weighted S&P, I think, is going to catch a bid. I think there's a very good argument for a breakout, a historical breakout in the S&P 500. But I think that valuations are so extended that my suspicion is that they would that cash would likely find a home in similarly safe and liquid assets. So I still like the short-term Treasury note. And finally, I'll add one more thing, which is emerging markets. I think emerging markets fixed income does phenomenally this year. That's my expectation. I think the dollar weakens. I think emerging markets foreign exchange appreciates. These are central banks that got their homework done, and they got it done right. And with India, for your Asian clients, I'm sure aware of this, but with India entering the global bond index from JP Morgan, that brings with it a huge amount of sponsorship. Anyone who invests in the GBI, JP Morgan GBI, is going to be investing in India, and India's bond market is paltry. So that's also going to be good for the currency and for equities. So I think emerging markets, because of that search for yield, because of the structural position that they find themselves in, now they're able to slash rates. And they've already started, especially in Latin America. Latin America also benefits from the robustness of the US economy. So I think emerging markets are also going to catch a bid, and that money coming out of cash is going to find a home there as well.
Thank you. I think that's a very relevant point on EM, particularly India, which was, the market is long waiting out here in Asia. So a lot of passive funds expected to go in to that market. I think we have just about time for one last question. This is about the U.S. Budget gap, budget deficit. How did it affect the U.S. Treasury's decisions on Treasury auction sizes? I think there was some noise this week about the auction sizes in the market, but yeah, if you could share your thoughts on that, please.
The affecting the auction sizes. Well, I mean, the one thing that the Fed's talked about repeatedly is, well, first of all, the budget cap, requires them, of course, to raise the money, and so it's just a function of where they put it, or at least where they draw it from. And so, I think right now, they try to keep, I shouldn't say right now, but for years or decades now, they try to keep bill issuance as a percentage of total issuance between 15 and 20% of total issuance. That number is currently 22%. So they're well above where they want to be. And there's really two ways to solve that. Obviously, issue less bills, issue more coupon bonds. It was a little bit of a surprise, I think, that the issuance out the curve did not rise more than it did. And in fact, I guess they made the statement that, after this one, or after this refunding period, they don't expect issuance to go up more at all. So, I mean, I think that's constructive for the market. I'm not really sure how they got there. It's not helping their bill issuance as a percentage of issuance. And honestly, I'm sorry, but I wish I'd have to dig a little bit further to figure out how they came up with their numbers.
Okay, great, Steve. I think on a final note, just wanted to make the attending clients aware that we will be making the PowerPoints available eventually through your StoneX rep. And last point, also, Kathryn and her team have done an extensive piece on 2024 market outlook, again, which we'll be sharing through your sales rep here in Asia. So thanks very much for attending again. Thank you, Kathryn and Stephen, for making time on your Thursday night. And we'll meet again next time on StoneX's FOMC call. Thank you.
Thank you, everyone.
Thank you very much.